Confession. Early this year, your correspondent predicted that oil production from shales and other low permeability formations would be declining by now, and that oil prices consequently would be set to rebound. He was only half right. Production of so-called tight oil has begun to decline, but the oil price, after having shown signs of life at mid-year, has sagged back below $60 a barrel. In projections for July versus June, in the U.S. Energy Information Administration's latest drilling productivity report, 3 of 4 oily tight formation plays showed output declines. The changes aren't large, down 29,000 barrels a day in the Bakken, 49,000 barrels a day in the Eagle Ford, and 17,000 barrels a day in the Niobrara, and up 3,000 barrels a day in the Permian Basin. Until recently, though, production in all 4 regions was zooming. Unforeseen early this year was a surge in production from key members of the Organization of Petroleum Exporting Countries. Remember the shock expressed last November when the exporters group said it wouldn't lower the group production target below 30 million barrels a day to defend the crude price? Total output by OPEC members has been at least 1 million barrels a day above that level since February, and it's rising. In its July oil market report, the International Energy Agency estimates OPEC crude production in June at 31.71 million barrels a day, the highest monthly average since April of 2012. OPEC output will rise more as sanctions against Iran dissolve. Meanwhile, global oil demand was looking perky until Greece ran out of euros and the Chinese stock market drooped. Market watchers have a word for this combination of supply and demand indicators: bearish. An important question is whether the reversal of U.S. tight oil production represents merely a pause or the start of a decline as dramatic as the preceding increase. Reasonable arguments support both alternatives. Caution, however, should preclude speculation on the matter from anyone whose early year forecasts turned out only half right, which means half wrong, but falls less crushingly on the ego. I'm Bob Tippie, editor of Oil and Gas Journal, and that's the editor's perspective that appeared first in text at www.ogj.com on July 10, 2015.